BND and AGG are two of the most popular bond ETFs for investors looking to add stability and income to their portfolios. Both aim to provide broad exposure to the U.S. bond market, including government, corporate, and mortgage-backed securities. They're designed to be low-cost, low-risk options for investors who want diversification without having to pick individual bonds. While they seem very similar on the surface, there are subtle differences that can affect which one is the better choice for your goals. Let's start with BND, the Vanguard Total Bond Market ETF. BND tracks the Bloomberg U.S. Aggregate Float Adjusted Index and includes a wide range of U.S. bonds, mostly investment grade, with maturities across the board. It holds thousands of bonds, giving investors exposure to government treasuries, mortgage-backed securities, and high-quality corporate debt. One of BND's standout features is its ultra-low expense ratio, just 0.03%, making it one of the most cost-effective ways to invest in the bond market. It's a solid choice for conservative investors looking for income and stability, especially for those using a buy-and-hold strategy. Now let's talk about AGG, the iShares Core U.S. Aggregate Bond ETF. It also tracks the U.S. bond market using the Bloomberg U.S. Aggregate Bond Index, which is slightly different from the one BND uses. AGG includes a very similar mix of treasuries, corporates, and mortgage-backed securities, and its portfolio overlaps significantly with BND's. AGG's expense ratio is slightly higher at 0.03%, matching BND's cost in practice, but it's issued by iShares, which some investors prefer for platform compatibility or liquidity. Now let's compare them directly. First, in terms of performance, the difference is negligible. Both funds have very similar historical returns because they track almost identical indices. The tiny variations come from differences in how the indices are constructed and rebalanced. But for the average investor, the difference in performance is barely noticeable. Next, cost. Both BND and AGG have a 0.03% expense ratio, so neither one has a cost advantage. That makes this category a tie. When it comes to liquidity, AGG generally has a slight edge with higher average daily trading volume. This makes it a bit easier for traders to buy and sell without affecting the price too much. However, for long-term investors who aren't actively trading, this difference is minor and won't impact most people. Then there's issuer preference. Some investors are loyal to Vanguard, known for investor-friendly practices, while others prefer iShares and the tools they offer on platforms like BlackRock. Both are reputable companies, so this often comes down to personal preference. So, which one is the better choice? If you're looking for a reliable, low-cost bond ETF to provide income and reduce portfolio risk, either fund will work. If you're already using Vanguard for your other investments, BND might fit more naturally. If you prefer iShares or use a brokerage that supports AGG better, then AGG is a great choice too. Both are virtually interchangeable for most investors, and your choice likely won't make a significant difference in returns. It all comes down to platform, preference, and how you plan to use the ETF in your strategy.